From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 1st, 2020 on the Macrocast. It's Tony Fratto coming to you from Southwestern Pennsylvania. Our friends from Markets Policy Partners, John Fagan and Brendan Walsh, are in DC. Guys, a lot of stuff this week. I mean, it was sort of, we got to the end of April. Usually it's March comes in like a lion and out like a lamb. And in a way, it was kind of like April came in like a lion and maybe out like a lamb. Had a big run up in equities for the month, even if it finished on a down day. So much happened this month, and some of that into this week also with and the second tranche of the PPP rolled out, which we're going to get into. We had a lot of earnings, so we're getting some clues from companies on how they're dealing with the current environment. Got some data between, we got another look at claims for an insight as to what's happening with workers filing for unemployment insurance. We'll look at the payrolls next Friday. But we also had two, interesting central bank meetings this week. We had, Jay Powell at the FOMC did his announcement. It did his presser. Looked like it was, I think, obviously the very first Zoom press conference for the Federal Reserve was interesting to watch and went off very well. And then Christine Lagarde announcing some new things at the ECB. And so let's start with central banks. So Jay Powell, I think it was one of these things where people were watching him for the first time. Still dovish, still accommodative. To me, the biggest takeaway, and I'd love to hear what you guys thought, but to me, the biggest takeaway was his clear direction to Congress and the administration that more fiscal support is going to be needed. And I always think, most central bank governors are pretty reserved. Jay Powell is very reserved and, probably even comes off as boring. But if you're a Fed watcher and listening to what he was saying, he was essentially shouting from the rooftops and banging drums and, blowing horns to tell Congress, don't think you can go away. There's a lot more to do here. How did you guys take the Powell announcement and press conference?
Yeah, thanks, Tony. Chair Powell was he was certainly reinforcing the dovish message of the Fed. The ultra accommodative posture is here to stay, and noteworthy that he opined that the Fed would be called upon to do more before this is over. And that certainly aligns with, as you said, Tony, his very sober assessment of the economic outlook here. And certainly so much of the pressure is on fiscal, the fiscal measures to come through and provide that bridge for businesses and households to the economic recovery that we all hope is in the not too distant future. And as a central banker, he knows there's not that monetary policy isn't necessarily well suited to this. But as we've talked about in the past, the Fed is now, to a greater extent than ever, blending monetary policy and sort of quasi-fiscal policy. The Fed's Main Street lending program is sort of the crown jewel of this kind of almost, it is encroachment into the sort of fiscal, into the fiscal and injecting money into the real economy rather than into liquidity, into the banking system and the plumbing, which is what the Fed's typical approach is. And I think that, the details are still coming together on, exactly how this Main Street lending program is going to take shape. But one of the things I guess I would say is that because the Fed is drifting, when Jay Powell talked about the Fed needing to do more, there was a lot of speculation about how specific he would get about what the Fed might do next, whether he would do a treatment of negative interest rate policies, which he has said are not appropriate for the U.S. in the past, and other Fed officials have agreed, whether they might consider yield curve control, which is basically having a target for the 10-year yield like they do in Japan, and some of these other things. He really didn't get that specific about it. There's also speculation that the Fed might buy stocks. My own personal view is that if the Fed is doing, pretty fiscally oriented work in the Main Street lending program, it makes it a lot harder for them to go do things like
Yeah.
stock purchases, right? They're going to be, it's a PR exercise. And if they're going to have to do more, doing direct support for the real economy is probably going to look more appropriate in this, if we have this long tail of the virus.
Well, given what equity markets have looked like, it's not obvious to me that that they're good deals for the Fed to go out and buy stocks. Are there? I mean,
no, it's a really important point. We're at 3,000. I mean, you know, there's some, you know, stress, but the big companies are still able to tap the markets. I don't know why they should buy stocks right now.
Yeah, I'm not a stock picker or an equity analyst, but it is weird, you know, just thinking about the markets. And one of the answers is going to be all of this, you know, fiscal support, but especially the Fed support for markets. But it is weird to look at the levels of all of the major indexes and say, you know, they're back to where they were in February. But I guarantee you, if I told you what the future was going to be in February, right, you would have predicted, 20% fall in equity values, even if I told you what the Fed and federal government were going to do. So it's a really weird situation. And so if you look at the valuations right now, and just say like, look, there's going to be a recovery. You know, we could argue over what the shape of it's going to be, but it's not going to be quick. And whatever it is, it's not in the medium term. Are we going to get back to output at the levels that we could have expected in the future just a few months ago? So the valuations really are interesting. You know, like the market's the market. It is like it's a bunch of, you know, a lot of people out there betting on the future, and they've got, you know, their view. It's just my view. I just don't understand how, you know, what the rationale is for future. Because I said, look, even if I think we're going to get the health situation right eventually, got lots of, I mean, really, I don't know if we're going to have time to get into it today, but, you know, really positive potential, medical research remedies. You know, we're listening to some of the news on the therapeutics. We had CEO of Moderna on this morning talking about their vaccine trials, which are looking very, very promising, and if they're successful, may come quicker than, you know, the 18 months that we were expecting. At the same time, there's a lot of damage, and it's going to be a while before demand comes back.
And also this week, the kind of popular narrative is that, you know, half the states are going to reopen. Reopen is not the accurate description of what's happening. And I was going through what Texas is doing. It's a slight loosening of very draconian restrictions. You know, restaurants are allowed to open only outside and only with 25% of the population. Most restaurants are not going to even bother to do that. It would cost them too much to do it. You know, you can maybe go get a haircut if you wear a face mask, but it's not like, you know, parties are happening, and we still have size restrictions, no more than 10 people.
Well, the equity market rebound, as I don't want to apologize for the S&P 500. I agree that it's we played bottom and not bottom. Both Brendan and I and Matt last week opined that the S&P 500 probably hadn't bottomed for this cycle, but this rally has been so heavily led by the big tech giants. I mean, if you're looking at Facebook, Amazon, Netflix, Google, these are companies that are, you know, with some exceptions, doing relatively well by the new dynamics of this pandemic response. That has they account for a greater share of the gains of the S&P 500 than they have ever in the past. And when you look at the rest of the rally, it's really been defensives led by utilities and consumer staples. Those are outperforming pretty dramatically. So the index level is offside, but the underlying details give you a much more cautious kind of flavor. And we think that, we think that that's probably going to come to bear. And this reopening, it's a really challenging situation. Right. Even when gradual, markets are going to be watching like a hawk the infection rates in areas where some loosening has occurred. We see in the overseas experiences, like in Germany and Japan and Singapore, most particularly, these secondary spikes can come up and reimpose lockdowns as a result. and that would be very dispiriting. I think that's a big downside risk for equity prices. And it's always worth mentioning, like, equity prices are optimistic, and they're always the optimistic market. The treasury market is priced consistent with a very long,
like,
dark economic situation.
Like this week, we saw a rotation because we're excited about growth, that, you know, the growth stocks outperformed. So banks were up 25% this week, but that still leaves them down 30% or so, you know, from when this whole thing started.
That's a great
point.
And
also going back to the point we made, you know, a while ago, the treasury market is basically pricing in, you know, zero rates for a long, long time. This is going to take a long time. The dividend yield on the S&P is, you know, 2.5%. So if you want to have any return globally, stocks is the only thing you can buy, and you just kind of got to hold your nose and hope for the best.
And hope, yeah. As we say, hope is not a strategy, but but it is, right. It's a hope, right? I mean, you have to have some. I guess you're gonna have to have some hope, and that maybe it feeds on itself also. But it's just hard to imagine that, as you said, like, just talk about retail establishments, right? I mean,
yep.
So, you know, if you're doing you know, social distancing, spacing, you're doing extra cleaning, which doesn't come free, it comes at a cost. You usually have a cleaning company that has to come in to do the deep cleaning, but you can only accept on a given day, whether you are a hairstylist or a tattoo artist or a restaurant, whatever it is, you can only accept 50% of the customers that you would on a normal day. You know, does your business work?
Yeah.
Right. And like, you know, maybe if hopefully you can do enough business to pay your bills and stay open until the day that you don't have to do the social distancing. But it's just the reason, if you go into a New York restaurant, the reason you're packed in so tight, you know, is that you got to get a lot of covers in that space because rent is really high. And, you know, if you got to pay, you know, you're paying higher wages, and, you know, it's tough. It's a tough business, tough margins. And, you know, and for retail is the same thing. And I think we want to get our friend, who was our retail analyst friend that we had on?
Oh, Matt Delafano. Yeah. So we've been tracking a lot of the real-time data. It's been fascinating.
Yeah. We're going to back on and just talk retail again, too. You know, maybe not next week, but the following week. You know, there's the likelihood that J. Crew is going to go into bankruptcy, seek bankruptcy protection this weekend. So, you know, there's just
Neiman Marcus has already filed, I believe.
They already have, yes, or Macy's, and the Macy's.
And Macy's is done. JCPenney's is done.
Yeah. So there's just a lot there, and maybe a bigger story, but again, that's just to note this. So thinking about the Fed's outlook and how it differentiates from where, you know, the way the markets, equity markets seem to be seeing things. You know, I think you need a more sober look at the future. You know, like that kind of loss of economic activity is a real real thing.
Well, Chair Powell, I think he spoke from the heart, and he specifically said, I think those least able to bear it are the ones who are losing their jobs. It's heartbreaking to see all the being threatened right now. You know, Chair Powell got criticized a lot for, you know, caring about the workforce too much, you know, and not being a hardcore central banker. I think she did a great job, but I think Chair Powell has showed himself to be much more on the side of having a heart like Chair Yellen than rather just paying attention to inflation.
Hey, let's talk Christine Lagarde for a minute. I mean, you know, ECB did some interesting things. I mean, maybe disappointed markets, you know, market expectations a little bit, where they thought, you know, she was going to maybe expand some bond buying. She did some other things with banks, though, didn't she?
Yeah, she loosened up the concessionary loan program. The really rolls off the tongue, the TLTROs.
I can. And the PRTLRO.
Yeah, the Paltrows,
right?
the Gwyneth Paltrows.
Gwyneth Paltrows,
which are basically a longer-term version specifically for the pandemic of the TLTROs, which are concessionary loans to banks, and with the condition that they lend them on to customers. And so that's She introduced the Peltros and lowered the rates on the TLTROs, but it was the main event is always about the big bond buying, and they left that untouched. There's a sense that Christine Lagarde is waiting and waiting and waiting. Like, Jay Powell has had, he's been pushing for fiscal, and Congress and the White House have been, obviously, we're on phase 4 and going into CARES Act 2.0. We've had a lot of fiscal plans come through. In the EU, they're still waiting for their big comprehensive package. The European Commission is still debating it. It's supposed to be 1.5 trillion euros or thereabouts, but they're still talking it over in terms of whether, the composition of it versus grants and loans and the overall size of it, and what are the different things. There's a really big North and South divide. They haven't been able to get agreement on it. You can see why why Christine Lagarde might want to hold back and kind of keep their feet to the fire a little bit. And we've seen central bankers, and particularly the ECB, do that in the past.
On the funding for banks, though, I mean, it's a pretty good deal, right? I mean, she's paying, it is a negative interest rate, right? She's paying 0.5% or a full percent on loans that European banks make, with the money that they borrow from the ECB. I mean, that's, you don't need to be a math genius on that, on how you make money if you're a bank, right? I mean, you could essentially loan it at zero and make money. So, but does it work? I mean, you're still pushing on a string potentially in that economy.
That's exactly right. And if the private sector doesn't demand loans because they don't have anything to do with the money, then there you are.
So we'll see what happens more on the fiscal side there. I mean, I think it's safe to say that look, I mean, both the Fed and ECB are doing, I think, all the things that they can do, as much as they can do. Even even though the Fed, Greg Gipp wrote in the Wall Street Journal wrote a great piece about this earlier this week about the Fed actually hasn't done some of these, or it's announced them. The announcements have had a pretty good effect. The municipal, bond facility isn't actually up and running yet. The Main Street lending program isn't up and running. We got more details on it now on the rate and how much banks are going to have to keep on their balance sheet, and the size of companies and the size of loans. They've sort of perfected it. And so that's, but people are, feel better about knowing that there's going to be a facility after that. I'm curious as to what the take-up is going to be. I just don't know. We have this funny feeling, maybe we can take a break. I'm going to come back and talk about PPP, but you get the feeling that the Main Street lending program is going to be perfect and underutilized, and the PPP is imperfect and oversubscribed. Right? Just like, like mistakes and chaos and problems with the funnel, and these banks are in and these banks are out. But we'll come back. Let's talk about PPP. But the Main Street lending program, it looks like, well, it's going to be perfect, but I'm wondering how much take up there's actually going to be for it. We'll see once they hopefully they'll get it out soon, and we'll have some actual evidence to talk about. But why don't we take a break here and come back? Let's get into PPP and then what states are doing to reopen and how that's looking. You're listening to the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at HamiltonPlaceStrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast. John, I want to get into PPP, but one of the things is, we saw was, President Trump making, a number of threats on, on debt, Chinese debt and Chinese tariffs, and, some think the market are paying attention to that. What do you make of his of the China threat?
Yeah, I think thanks, Tony. Those comments got a lot of play this morning, and certainly with futures down and the markets selling off to start the day here, it was tabbed as one of the things that might be weighing on sentiment. I think that's probably overplaying the impact of it. President Trump, no secret, he has in his freewheeling press conferences that he throws out a lot of things. He thinks aloud and muses about stuff. Whether obviously there's a retaliatory intent to some degree against China, whether they actually would act, whether they would really actualize that with tariffs or some other thing, I think I think that is very speculative at this point. And National Economic Council Director Kudlow came out this morning to kind of tamp down that. He says there's no rush to new tariffs that he knows of. And I think that's probably, I would take him at face value. There are reports, however, that the White House is exploring limiting the government savings program from investing in Chinese assets. That's something that Senator Rubio is pushing. We have been of the opinion that is probably coming through at some point, and down the road here, that might be the first port of call that they go into. Clearly, we've said in the past that on the other side of the infection peak are going to be recriminations, and clearly the administration, they've focused on China as the bad actor here, and they have a fair point to make on that point, that the Chinese government has some things to answer for on this, and just how that plays out, I think we'll watch it, but we don't think that's going to be a huge disruptor in the short term.
Yeah, I mean, it should look, no excuse making or apologies for for China. Just looking at it objectively, countries can do what they need to do if they, what their policies are to defend themselves. Like we learned in the trade war, though, should just remember that China is not without its own tools in this also. And so if it chose to retaliate by kicking out American firms or dialing down its purchases of U.S. Treasuries and choosing other dollar-denominated assets to buy, it'd be hard for them to do it. It'd be costly for them to do it. It's not what they want to do, but they could. They can. There are other options for them, and so just remember, like, the pain can go both ways on things like that. So. I agree with you. Shouldn't worry about it in the near term. Even if we're just thinking about things like, the capacity to produce a therapeutic drug or a vaccine. If we want that for us in the world, we're going to need all the production that we can get to churn out billions of doses of things, and that would have to include the productive capacity of China as well. Our productive capacity here, we're trying to help with with PPP. PPP program ripped through the original $349 billion. Finally got an additional $320 billion this week. That's starting to come out. Secretary Mnuchin announcing that any loans above $2 million are going to be audited. They did a little bit of refining on the guidance to companies on what to consider if you're gonna seek these loans. You got a number of people who are clearly eligible by statute to be able to get these loans, who have been by sort of some public shaming have given them back. Some of them clearly I think are going to be the poster childs of the wrong companies to get it, like the Lakers. I said, Lakers.
As Celtics fans, Brendan and I are thoroughly unsurprised by the conduct.
Yeah, me too. No, seeing the buses, I wasn't surprised either. Although I was thinking, it was like, man, that was a bad decision, but not nearly as bad as signing Luol Deng. Right? The Luol Deng signing was way worse and way more costly.
Way more costly.
Yeah.
I think they're still paying.
Look. Yeah, look, it's funny that I said in a previous segment about the PPP. It's like the Trump administration out saying it's wildly successful and sort of minimizing the problems. It could be both things. There are significant problems with the program, and it's wildly successful.
Yeah.
Right. And to me, I think there are a lot of problems you could talk about. To me, by far the biggest problem, we wouldn't be talking about whether this company or that company got a loan if we didn't keep running out of money, the failure of them to appropriate enough money so that all the companies statutorily eligible can actually go get it, not have to worry about getting, the door closing in front of them before their bank can move their papers through. And, so it has been beset by a lot of these problems, banks being criticized. They did this weird thing SBA did the other day where they halted applications from large banks at 4 o'clock in the afternoon. And then from 4 o'clock until midnight, only, small banks could, move their loans through. And, that would lead you to think that, well, I mean, I guess, small banks are probably lending to small customers, and that'll be a good, way of getting that done. And the big banks aren't doing that. And of course, it's the opposite, right? I mean, like we're saying, like all the banks are overwhelmingly loaning to small customers. It's just, this mythology because of some of these big companies that have been in the news is just not right. I mean, overwhelmingly, we're talking about really small companies and really small loans by all the banks.
And the metrics that are being put out are, in New York, the X amount went to big corporations, and the small guys aren't getting it. And they've only made like 40% of the loans possible. But if you're in Nebraska, 90% of the loans have been accepted and put out, and it's all small. But that's just the reality of the two places. If you're in rural America, you bank with a small bank and you have a small company. New York, JP Morgan, Bank of America City, there's 18 million people in the place. So they just have way more clients and loans that they have to process. So shutting the big banks off at 4 does the exact opposite of what you need. The big banks need to flood the system because they have that many applications to get through. And it's not that they're ignoring their small clients. They just have clients among all the spectrum from small to big.
Yeah.
I think one of the other challenges for this program is really from a market's perspective. It's just hard to evaluate the success. Obviously, the policymakers, the success is about getting those loans out. And, that is all that they can control. And that is the benchmark that they should be using, getting those out to the most, in the most targeted and broad way possible and timely way possible. From a market's perspective, what matters is what's the impact on the economy? Does it really give supports? And unlike Fed programs, I mean, it's an exaggeration, but the Fed presses the button and the market goes up, right? I mean, you get this instant gratification with Fed programs that you just don't get with the fiscal. You get the announcement effect and people are excited and happy about it and think that, well, this could certainly help down the road. But then you've got to really wait and, play the waiting game and see, it come through in the data. And that's a really, it's a really challenging thing for markets to wait around for these effects to come through and to play the but for the PPP, things would be worse. That's cold comfort if we have, very impaired economy going into June. So,
well, I think at the rate they're going, we are going to run out of this money again, and probably have to come back to Congress for more. And we'll see. We'll talk about more about that in upcoming shows. But like the clock's going to tick down, and I think we're going to be right back where we were. Now, hopefully, that will fuel the support for a phase 4, whether it's what we call it, phase 4 or CARES 2, whatever we call it, for that next tranche of money that we're going to need. So
and you also have states and municipalities that are quickly running out of money.
Yeah, they're running out of money, and they're this is turning into a partisan battle. Democrats want support for state and local governments. Republicans are turning against that they don't want to be financing what they see are bad fiscal policies at banks and at states and cities. And it's unfortunate if it just turns into a political partisan battle on this, because it's not going to help anybody. Certainly, if you're a Republican or you're a Trump administration, it's not going to help you if cities are laying off people and not contracting work for all the things that, you have to forget about you have to think about what an economic engine a municipal government is. They're paying for, grass cutters and landscapers and painting and their staff and people and necessary services, right? If they start laying that stuff off, but your objective, just forget the economics of it. pure political standpoint is you want the economy to come back so that you can get reelected in November.
We forget that there's an election going on.
Yeah, that's not a recipe for getting reelected, to have
I'm with you.
continued drag on the economy. So
I think it's going to be a little bumpy, but they'll get it done.
Yeah, I think you're right.
But the president might have to take the reins on this one.
All right, hey, why don't we let's take a break and come back and talk about. I'm going to look at. We have some interesting earnings this week, and let's look at that. Look a little bit at the data and what to look ahead for next week. This is the HBS Macrocast with Markets Policy Partners.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
Okay, we're back on the Macrocast. John, we got some earnings with the weirdest earnings season ever. But what did we see this week? What's the story of the big names this week?
Well, this was really an enormous week of household names reporting, and the headline coming into yesterday was really that the big tech companies were validating the optimist case that they were doing relatively well and weathering the pandemic and in some ways benefiting from it. We had earlier this week, we had Google, Facebook, and Microsoft all come out with good numbers. The markets were clearly in very upbeat mode, and Amazon and Apple were after the bell yesterday, and they were expected to keep the party rolling, and it was something of a different story. The call with Amazon was sort of the main headliner. iPhone sales made Apple look a little bit squishy, and they canceled guidance for the next quarter, but that wouldn't necessarily be all that out of line with expectations. But it was Amazon, the discussion about second quarter and the spending of the outlook for spending almost all of their second quarter profits to basically bulwark the company and its employees against the risks of COVID, and to try to keep their services and workforce up to the task that is facing them. And it is an enormous task. I mean, we have everybody, Amazon has taken a more central place in everybody's lives over the past couple of months. And so that was that was out of line with expectations, that kind of tone and that kind of viewpoint for the coming quarter.
Yeah, you're also seeing, the pharmaceuticals companies, when the analysts are asking them how you're going to make money off of these stuff, they said, we're not. This time is different. This is about saving the world. So that's nice to see.
Yeah. So we've seen equities take a sell in May, get rolling on the old sell in May and go away approach. It's a bad start to the month, but after a really torrid April.
The other interesting
makes sense.
Thing from this week, we got a lot of the payments companies, Visa and MasterCard, and while obviously their first quarter was heavily impacted by the virus, you're seeing acceleration of people switch away from cash to debit and credit, which in the big picture is a good thing for these guys. So the market's is looking now at the future in terms of how to value these companies rather than the immediate present.
So look, we got the big on data this week. Obviously the big number, which it's funny to look at a number like 3 million plus people who filed for unemployment insurance their initial claims, and say that was a relatively good number. Relative to expectations, right? Could have been people expecting, or could have been well over 4 million. There are still a lot of problems in the states, though, aren't there, Brendan? I mean, just people having trouble.
Yeah,
getting
especially
through.
Florida. I mean, Florida it might have a backlog of close to 1 million people still. So just the system was never designed to. Florida, it was a special case on their own, but the whole global U.S. system was not intended to have 10 million people a week try to get these checks. But the reality is, we're going to have over 20% of the workforce out of work, but it looks like by the end of within the next week or two, everybody that should be getting an unemployment check, is getting it. I also think it's good. We're paying people to stay home, but is a line cook really going to take a pay cut to go risk his life to make hot dogs? So I think a lot of companies are going to have a harder time reopening just because they're going to have a hard time staffing it. But next
I think
week,
that's right, and especially and you still have the $600 bonus out, weekly bonus out there too.
Right.
So
and some people are criticizing we're paying people to not work, and my response is yes, that's the
exactly.
total point.
That was the point.
It's working.
Yeah.
But next week the Royal Bank, Reserve Bank of Australia, and the Bank of England have meetings, but the big guns have been fired. So I think it's more clarification rather than huge news. We also get some services PMIs in the U.S. and in China, but that's kind of the big stuff. The one that matters will be the employment report.
Well, we'll be looking forward to that. I think it's. I mean, we could save our. Well, I don't know. We're not going to get to make our guesses, huh? I mean, do you have a guess on this? This is the only time we're not going to do a bonus show next week unless something crazy happens. So,
right.
What do you wait? Give me your best guess next week on April jobs. Yeah,
because it's are you employed the week that includes the 12th of the month? So March really didn't capture the whole thing. So we'll get payback, and whether it's revised into the March number or it's added into April number, I think you're going to be looking at job losses in terms of the way they do it. Probably over 5 million, and the unemployment rate is actually a bigger survey, and I think that can capture it a little quicker. I think that's going to be closer to 20%.
I think when we go into it next week, and we'll have Matt McDonald with us too, and we'll talk a little bit about just the some of the nuance and complexity around the jobs report. Just in terms of the counting and technically speaking, for BLS jobs, you have to be actively looking for a job. But if you're unemployed right now, you're not actively looking for a job. There are no jobs to go actively look for, and the expectation is that you're going to go back to your job once they allow you to. So it's a really unique, different situation. We'll spend a lot of time. We'll do the whole show on the jobs report next week.
No, totally, yeah. But it also goes to show why real-time alternative data sets are going to be more important now than they ever would in the past, because our BLS system wasn't designed to try to capture this immediately.
Yeah, I agree. All right, guys. Well, have a terrific and safe weekend. We'll see you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.